So we're continuing to work through the financial ratios, and here we are doing the calculations for the industries, and we're looking at the motor vehicle industry and the hotel industry. Again, if you're doing the assignments in this course, then you are going to calculate the non-store retail and the restaurant industry, so that you can also then calculate the financial ratios for particular businesses and then compare. But for the points of practicing today, we are moving through and looking at the hotel industry and the motor vehicle industry. All right, so when we left off, we were looking at receivables to working capital. So the next one we're going to look at is inventory to working capital. So we're looking at operational efficiency here. If your number is less than 1, you are considered to be highly liquid. Okay. If the number is too high, you have too much inventory. See if I can write this vertically here. All right, so that's all part of this one here. So less than 1, 2, we are highly liquid. We don't have a lot of inventory. If their number is too high, then we have lots of inventory. So again, with this one, because the industry is going to determine how much inventory it should have, right? So if we think about motor vehicles, we're producing cars and trucks. We have a lot of inventory. If we are more of a service, then we're not going to have a lot of inventory. And so we need to, for this one, I'm not going to give you an exact number in terms of what we're looking for. It is going to really depend on which industry you are in. So we want to compare to the industry, but if you have less than 1, then you are very liquid. And if the number starts to get too high, then maybe you're holding on to too much inventory. So let's take a look at what's happening here. And you can see with the motor vehicle industry, they're sitting at 9. So you'd want, if you were Ford, to say, okay, well, how do we compare to that? If our number is twice as high, then we have way more inventory than is typical for vehicle production. So we're looking at operational efficiency. Remember, if you have too much inventory, the problem is that it depreciates, it loses value. We have obsolescence. Nobody wants a car or a truck that was made 5 years ago to be sold as new. And so you have to really balance how much you're going to have of your assets, how much you're going to have tied up into inventory. Let's look at the hotel industry. Okay, so we're looking at inventory to working capital. And this inventory is going to be like the inventory we looked at before, which is we need to first take the average of the starting inventory and ending inventory, opening and closing. So we did in the previous video, we took from if we go to the hotel industry, we took that opening inventory and closing inventory, add the two together, divide by 2, we get the average level of inventory. And so that's this 72.2 that you can see here. So we want to take that 72.2 and we want to divide by working capital. And we talked about in the previous video, working capital is going to be your current assets minus your current liabilities. And so just like we saw in the previous video, when we're looking at that working capital, the challenge we're seeing for 2021 in the Canadian hotel industry is that they have a lot more debt than they have assets. So that's going to make this inventory to working capital number negative. And then we can also look at how big it is. And so when we're looking at inventory to working capital, notice that the hotel industry is a much smaller number. Ignore the negative. If we look at simply the size of the number, you'll notice it's much smaller. And that's because hotels don't have inventory. What they have is they have those fixed assets. Remember, so we want to differentiate between buildings and equipment, that's fixed assets, and inventory. The motor vehicles have lots of inventory, lots of cars that they produce. And so you can see the numbers are quite different. And that has nothing to do with the performance of the industries themselves, but the type of industry that they are. Okay, so we are looking here And the hotel industry, because it doesn't have a lot of inventory, service industries, they are going to be more liquid than, by definition, than a company that has, that produces something, manufactures something. Now, if we're looking at like the motor vehicle industry and we see that we have low numbers, so if this, instead of being 9, was below 1, then they have insufficient inventory. Okay, they just not producing enough. And so within the industry, we can look at, is the number too low or too high? All right, let's go to our next ratio. So our next ratio is called collection period. So collection period is actually not a ratio as much as it is a measurement of the number of days it takes for people to pay you back. So the collection period you see here says accounts receivable. So that's your customers owe you money, divided by our average daily credit sales. Now, when you look at the balance sheet and you look at, so I'm going to go back to our slides here, average daily credit sales. So when we look at an income statement, you don't see the average daily sales, just don't seem to be listed here. And when you look at the balance sheet, they're not listed there either. So we need a way to approximate those daily sales. So I'm going to go back to our sheet. And so the collection period, we're actually going to calculate collection period here. We're going to take accounts receivable, just like you see in that formula, and we're going to divide by sales, and we're going to times it by, maybe I'll just move this out of the way here, the number of days in a year that our business is operating. Okay, so if we are open 7 days a week, then that's going to be 365 days. If we're only open 5 days a week, we would take 5 times 52 weeks, and we would find that number of days. So here we have a number of days in a year. So what we're trying to do essentially is to take our sales amount and fraction it by the number of days we are selling things to figure out kind of what a typical day's sales looks like. That's all this calculation does. Accounts receivable divided by sales times number of days that your business is operating in that year. So for a simplification, we can assume our business is running 365 days every day. We would adjust that if we are not open every day. And so we need accounts receivable divided by sales times days in a year. So let's go here, find our spreadsheet. All right, move it back over so we can see simultaneously. So what we get when we do that calculation for motor vehicles is we're getting 10.4 days. So that means that when customers buy something from a dealership, essentially the payment is being processed within 10.5 days. Okay. Now let's look at the hotels. So we need our accounts receivable. So I'm going to pull up our hotels here. Wrong spot. Collection period, accounts receivable. Okay, 5139. And we are going to then divide by our sales. And so remember our discussion in the previous video, we have multiple sources of revenue. We want the sales of goods and services. It's possible that our assets are getting us additional revenues. Maybe we're selling off assets. And so you see that all other, but we'll ignore the all other and we'll go with 806,510. 806,510. And then we're multiplying this times the number of days in a year that our business is operating. So let's assume that most hotels are open 365 days a year. And it's not a percentage. So stop making it a percentage. Make it a number. It's not a dollar amount either. Just make it a plain old number. Plain number. There we go. All right. So the collection period for hotels is 23 days. Remember, now, if we have more sales based on credit cards, right, there's a processing time. And so what you see in the hotel industry is that it's taking about 23 days for us to get the money from when somebody stays in the hotel. Okay. The idea with the collection period is that you would like that number to be less than 60. So typically, if your customers haven't paid you within 60 days, then they start to get notices. More than 90 days, then we start to have a third party try to collect the money on our behalf. And so you're looking for collection less than 60 days. If it's going to be based on credit, right? You can think about when you pay your credit card, it's kind of on a 30-day cycle there. If your number is too high, your collection period is a lot of days, then you're selling to people who have a lot of, who aren't paying you. So you have a lot of bad debts. People owe you and they aren't paying you. The lower your number, so the smaller the collection period, the more cash flow. So we're going to have more cash on hand, and that goes back to this receivables to working capital. Less capital that's tied up and more cash we can use to fund the daily operations of our organization. So lower collection periods are better, but depending on how people buy your product, it will change the number of days in that collection period. So we can calculate collection period again, just because that's a little blurry here. Accounts receivable divided by sales times number of days in a year. All right. So the next one we want to look at is net sales to inventory. So are we effectively utilizing our inventory to generate revenue? So to do that, we take net sales divided by our inventory, and a higher number is going to be better because we want the inventory to move, and we create something, we make that car, and we want it to turn into the sales of that vehicle. So that means revenue being generated. So higher is better. If it is too high, then we've missed sales opportunities because we have stockouts. We can't keep the inventory on hand, so people keep coming to look for our vehicles and they're not there. So you don't want your net sales to inventory to be too high, but in general, higher is better. If it's too low, then we have excess inventory. That is, we are producing something and it's not moving. It's just sitting on the shelf and people aren't taking it. So let's take a look here at our net sales to inventory. So we're looking at 2021 in the motor vehicle industry and in the hotel industry. What we see here, a 0.93 for motor vehicles. I'm just going to squeeze this down so it fits a little better there. Net sales to inventory of 0.93. So this is problematic. This means that we are producing inventory, we're making trucks, and they are not being sold. Because that net sales to inventory, we want that number to be bigger. We want it to be more than one because we want to be adding value to the organization. Well, how do you add value? You sell something for more than it's worth. And if the inventory sitting there is worth $2 and you sell it and it's gone for $4, then our net sales to inventory is going to be 2. But if we have a number that's less than 1, then the inventory that's sitting there is worth more than the money coming in, which means our inventory is just sitting there. So we look at that net sales to inventory, and we talked about the car dealerships producing all these vehicles. They have a lot of inventory, but they can't sell them because they're missing one piece. We can see that here in this net sales to inventory of a 0.93. All right, what about the hotel industry? Well, we need that net sales calculation. So we'll go back to our hotel. And we have 806,510. And then we are dividing that by our inventory. And so again, here we are doing inventory is calculated as opening inventory plus closing inventory divided by 2. So we're taking an average of that. And we can see here that 74.4 and 70, the average of those two halfway in between is 72.2. So we divide by 72.2. So you can see here a much higher number for net sales to inventory, and that's because the hotel industry is not having that same issue that motor vehicles are having, right? The other is that we talked before, the hotel industry doesn't have a lot of inventory. Service-based businesses don't have a lot of inventory. And so your net sales to inventory numbers are naturally going to be higher because you don't have a lot of inventory to start with. Okay. So here, that financial ratio of net sales to inventory is not a key financial ratio we would look at if you're in the hotel industry to monitor progress and performance, because we just don't have a lot of inventory to start with. Whereas in a motor vehicle industry where there is a lot of inventory, or in a company that manufactures, if you're Coca-Cola, if you make pipes, whatever, if you're someone who produces goods, then these financial ratios that are related to inventory are going to be important for looking at how well your business is performing and how well it's being managed. All right, so here we did the net sales to inventory. Too high, missed sales opportunities; too low, excess inventory. But again, industries that have very little inventory will have high numbers to start with. All right, so the next one we're going to look at is what's called the inventory turnover ratio. We often see this one reported more often than the net sales to inventory ratio. And the idea here is this one tells the number of times that the inventory is sold. We had actually looked at, so I'm going to go back to the slides. Earlier in a previous video, we looked at, where's my inventory turns? There we go. We had looked at the number of inventory turns. So this is how many times we are going to go through our inventory, typically in a year. You can see we can take days of supply, we can calculate it. We take 365, that's days in the year, if your business is operating 7 days a week, divided by the inventory turns, and that shows you how many days before you replenish your inventory. So in a previous video, we looked at the retail industry, for example, has an inventory turnover rate of 10.86. So the days of supply, if they're selling 365 days a year, 365 divided by that 10.86 means that they're restocking their inventory once every month. Okay, so when we look at inventory turnover rates, higher means we move through the inventory quickly. Too high, though, means that we can't keep enough on hand to make the customers happy. The second it's in the door, somebody buys it and the shelves are now empty again. So too high of an inventory turnover rate can be problematic, can be stockouts, angry customers because the shelves are empty. Right now, you go to look for cold medicine, for example. Even though most people think COVID's over, supply chain issues, production issues, years after COVID has ended, having this ripple effect mean that there's a lot of empty shelves when it comes to cold medicine. So the inventory turnover rate is super high right now because the second that cold medicine gets put on the shelf, it's gone. And we're back to empty shelves again. So that's a lot of inventory turns, and the days of supply are very small. So too high of inventory turns, too small of days of supply means that you have stockouts, back orders, unhappy customers. But you don't want those inventory turns to be too low, because then you're not moving inventory. No one's buying your stuff. Days of supply being too long is a problem because you're not moving your inventory and no one's buying your stuff. So let's go back to look at what we have here. And so if we look at the motor vehicle industry, our inventory turnover ratio here is 0.79. And you can actually take 365 divided by, so assuming that the automobile manufacturing and sales is open 365 days in a year, we could divide that, and what you get is a problem. Days of supply is more than a year, right? We can see that because the inventory turnover ratio is less than 1. So in 2021, there's an issue with vehicle production because it's not moving. They're sitting on a car for more than a year. And as I said earlier, nobody wants to buy a 2015 truck for brand new prices, right? We want the new car. We want the current year's car. And the issue with producing these vehicles, making them with everything except for this one chip that they need, means that that inventory is sitting there. And it's not moving out the door and turning into sales. And so these cars were sitting for over a year before they turned into revenue coming in. So inventory turnover ratios that are below 1, that's more than a year that product is sitting there. All right, we can look at it for the hotel industry. Again, they don't have a lot of inventory, so probably not something you would focus on. We would with more of the restaurants, the retail. If you're looking at Amazon, for example, inventory turnover ratios are particularly important. We have warehouses full of product. How long does it sit in the warehouse before it moves? That's days of supply. If you take that and look at those days of supply, well, if that days of supply is 30 a whole month, then we're only turning it over 12 times a year. So you can go with inventory turnover ratio or days of supply. Lower days of supply or higher ratio means we're moving it out the door. So let's look. Inventory turnover ratio for the hotel industry. Okay. So what we need is the cost of goods sold divided by our average inventory. So we already have the average inventory, that's 72.2. Now we just need our cost of goods sold. Okay. And because the hotel industry isn't making goods, they call it cost of sales. And so you can see that's the 30/18/30 that is listed there. So we can take this and take our inventory and divide by 30/18/30. All right, where did I screw up here? All right, we have our inventory. 72.2, and we're going to get quite a low number there. Again, they don't really have inventory that for it to move. So they don't have much inventory. So again, this is really not a very relevant calculation for them. Just checking here. All right. Just trying to check why my numbers don't match. So I'm just going to do a double check here. Hotels B23. We have 30130. Okay. All right. Oh, that's divided by. Okay, did I go the wrong direction here? Let's see. All right, so inventory turnover ratio. Let's go back. Okay, so cost of goods sold divided by average inventory. All right, dyslexic moment here. All right, 3018.3. So that's our cost of goods sold goes on top and divided by our average inventory. There we go. All right. All right, so here we have that inventory turnover ratio we can see is quite high, not holding on, turning it over quite quickly. Days of supply would be very short. We could find those days of supply, 365 divided by 41.8, and you can see that that inventory is being turned over every 8.7 days. And so if you think about a hotel, what inventory do they have? Well, they have shampoo, conditioner, those types of things. So they're moving through it quite quickly. It gets replenished just a little bit more than a week. But they don't have a lot of inventory, right? Most of what they're providing is a service. And so this ratio, again, not as important for them as for someone who manufactures goods or sells in terms of retail. All right, so let's look at the next one, which is net sales to working capital. So net sales to working capital, what we're looking for is we're looking for how well the funds, so we talk about working capital. Working capital is going to be the funds that we're using to generate profit, right? What we have, the assets we have available for our operations. And we want to compare that assets we have or the funds we have to fund our operations, compare them to the revenue that we have. And so the idea is that your assets should bring you revenue, which should turn into profits. So we should have more funding to generate profits, and then we should have more revenue to generate profits. And the funds we use to generate profits should grow with the revenue we use to generate profits. Like they should both be increasing. And so we look at a ratio of net sales to working capital. We're looking for a number. Let's see if I can get this to show up. Okay, we're looking for a number here, probably about 1.5 to 2. If it is less than 1, we're going to have a liquidity issue in the future. Future liquidity problem. Okay. So because they should be growing together. We should be having our funds that we use to generate profits should be growing with the revenue used to generate profits. Otherwise, all you're doing is slashing expenses and you're not just growing what you have to help create and produce more to bring in more money. So net sales to working capital, 1.5 to 2, less than 1. There's going to be issues in the future in terms of having enough funds to help generate future profits. There's just not going to be enough cash on hand. So let's take a look at our net sales to working capital in terms of these different industries. So we look at motor vehicles here. They're sitting at 8.48. They have lots of revenue here compared to, remember, working capital are your current assets minus your current liabilities. So it is the cash. It's what you have in order to fund those operations. So here we have a higher number here. Let's look at our hotels. So net sales to working capital. Again, remember they have an issue because their working capital is negative. When we look at the net sales, we have 806,510. And then we divide and we get current assets minus current liabilities. We had current assets of 52,2310, but the liabilities were bigger at 79,42,9. So again, they have an issue where their liabilities are more, their current liabilities, their debt is more than their current assets. And then we can look at, separate from that negative, we can look at how much sales they have compared to that working capital. And so we can see that it is a higher number here, but they do have this issue of that debt versus the asset value. Okay. So in this case, the number is even less than 1. So future liquidity problems, right? Because we got a negative number. All right. We got a couple left here. We have looking at our long-term liability to working capital, our debt to owner's equity, our current liabilities to owner's equity, and our fixed assets to owner's equity. So let's go through the last of these. All right, so we are looking at long-term liabilities to working capital. Long-term liabilities, so we've been looking at current liabilities. In times we're looking at working capital. We were taking the current assets minus the current liability, so short-term debt. Here we're looking at long-term liability. So this is debt that is more than 12 months. So what we're looking at is the debt longer than 12 months versus the assets that are owned. So we take our current assets minus the current liabilities, and we're looking at the more liquid ones, right? So things like cash. So here we're looking at our long-term liabilities, the debts, versus those more liquid assets. And what we can see when it comes to this long-term liabilities versus working capital, if you are less than 0.5, then you are very dependent on short-term debt. Okay. So if the number is very small, then we're highly reliant on current liabilities, a lot of short-term funding. If it is more than 2, then what we're looking at is we have a lot of long-term debt. So we're looking for a number somewhere between that 0.5 and 2. Not too much long-term debt, not too much dependence on short-term debt. Between 0.5 and 2. So let's take a look. Here we have motor vehicles, and you can see them at 0.5, so just kind of below that benchmark of being too dependent on short-term funding, right in that range that we determine is appropriate. And then let's look at the hotel industry. What does their long-term liability to working capital look like? So we're looking at long-term liability now. Previously, we've been looking at current. So long-term liability here is 170,570. And then we're dividing by working capital. So again, that is current assets minus current liabilities. $79,4290. Okay. So it's going to be negative because they have more current liabilities, more short-term debt than they do assets. So we already said that that's a problem. And then we can look at the number itself. Notice the number, if we ignore the negative, is at 6. So now we can see here that they have a lot of long-term debt. If you think about the hotel industry, a lot of it is going to be long-term debt, right? It is very costly, big fixed assets. The whole hotel building is going to be something where we owe and have to pay off over multiple years. And so their long-term liability to working capital is typically going to be higher, ignoring the negative, it's going to be higher in a hotel industry where there's lots of fixed assets, versus other types of industries. So then we need to compare, does Best Western, how do they compare in terms of their long-term liability to working capital? And maybe they have paid off or they have less long-term debt. So their number is lower than industry. Or maybe they have just acquired a bunch of new locations and their long-term liabilities are quite high compared to working capital. The concern, of course, is the ability to pay off the debt and how well you can access, how liquid you are, how well you can access cash and things you need to fund your daily operations. If too much of our money, too much of our assets are tied into long-term debts, then it becomes risky when things like interest rates go up. And so we have to balance the short-term debts and the long-term debts. But again, industries that have more fixed assets, more equipment, more buildings, they're going to have higher numbers naturally anyway. All right, let's take a look at debt to owner's equity. So debt to owner's equity is another one, financial ratio that you do see a lot. Current ratio acid test, probably the most popular, the most famous. But debt to owner's equity probably comes in third place. Here, what we're looking at is how are we financing our company? Are we doing it through debt? So are we borrowing? Or are we doing it through equity? So do we have investors? And what is the ratio of debt to owner's equity? We can see here with the motor vehicles, they're sitting just above 2. Okay. And so we're going to look in just a moment at hotels, but what are we looking for when it comes to debt to owner's equity? Well, in the previous videos, we talked about how you might prefer debt because it's easier to control for your organization as opposed to equity. Because if you sell stock and people own parts of your company you are paying them in perpetuity, right? So you might prefer debt. So when we look at the debt to owner's equity, you notice that the number is slightly above 1 in terms of we prefer. We prefer, where it is, about 1 to 1.5. Okay, a bit more debt than owner's equity because of, as we talked about in the previous video, that sense of control and management for the organization itself. Now, if you have a capital intensive industry, so maybe you are finance, you handle lots of money. Maybe you're manufacturing, you handle lots of inventory. So in capital intensive industries, that debt to owner's equity is going to be higher, 2 to 2.5. Okay, so if we think about it, right, if you're going to be a capital intensive industry like manufacturing where you have a lot of equipment and you have a lot of inventory, then often that's going to be more financed through borrowing. And so your debt to owner's equity will be higher. So 1 to 1.5 for debt to owner's equity across the board. But if you're more capital intensive, more finance, more manufacturing, then it's going to be higher, 2 to 2.5. All right, so we had said a moment ago that motor vehicles are at 2.05, which makes sense. They have a lot of inventory and they are more manufacturing, more capital intensive. All right, let's take a look at the hotel industry. So let's look at their debt to owner's equity. All right, so here we're looking here at total debt, so total liabilities. 24,995.6 is debt, and then owner's equity 83,5620. So you can see there their debt to owner's equity is higher at 2.89. Okay. So again, because they are more capital intensive, right? Those fixed assets, they are going to be a higher number. And so we can see again, they're in the two range. All right, two more. Current liabilities to owner's equity and fixed assets to owner's equity. Since you're probably getting tired of financial ratios by now. All right, current liabilities to owner's equity. So notice that this formula is very similar to the one we just looked at. The difference is instead of all liabilities, all debt, we're just looking at current liabilities. And so here we're looking at the ability to meet short-term debt with our investments. When we look at this current liabilities to owner's equity, the lower the number, so the more equity we have and the less short-term debt that we have, the less we're likely to default as an organization. That is, fail to pay back the money we borrowed, to pay the loans, to pay the debt. And so a lower number means that we are less risky because we have more money coming in terms of investments, and we're going to be able to then pay that short-term debt, that current liability. So let's take a look at these current liabilities to owner's equity. We can see here motor vehicles, 1.56. So again, we expect that ratio to be lower than the debt to owner's equity because we took out the long-term liability. So the number is going to be lower than the debt to owner's equity. It's focusing just on the short term. And the lower the number, the less likely we are to default, the less risky we are because we're able to pay that short-term debt. All right, let's take a look here at the hotel industry. So we need current liabilities. So we have our current 79,4290. 79,40. Got too many numbers in here. 79,4290. And we're dividing by our owner's equity, 83,5620. 79,4290, 83,5620. Right, and so you notice this number here is less than 1. The debt for the hotel industry is not short-term debt. It is more longer-term debt, as we can see if we look at the balance sheet. That's right here. You can see that long-term versus the current liabilities. So less than 12 months, more than 12 months. We're buying big buildings. We're building big hotels, right? And so there's a lot of long-term liability. So in terms of the investor's perspective, the hotel industry is not going to default. They're going to be able to meet that short-term debt because of the equity that's in there. So we had concerns with this hotel industry not having enough assets. But if we look at the equity, that equity is then helping to cover any of those debts. But as an investor, we want to know, of course, if we're going to get a return on our investment that we're putting in. And so here, that goes back to the net profit to owner's equity being low because the hotel industry is not making money for those investors. So we look at all the financial ratios kind of in combination together. All right, last one, fixed assets to owner's equity. So we're looking here about how our equipment is funded, how those buildings are being funded. So remember, our fixed assets are going to be our plant, our equipment, our buildings. And so here we need to take those fixed assets. And if we're using the industry reports from Industry Canada, remember fixed assets is going to be net tangible and intangible assets. We're going to use that for that number. So that's our 21,057.70. And then we're dividing by owner's equity, 83,56.20. Okay. Now, when we look at fixed assets to owner's equity, there's a couple different ways we can look at this. So I'm just going to put this over here. So if we have a fixed asset to owner's equity that's less than 0.5, then that means we are mostly leasing. We are renting our equipment. We don't own it. Okay. If we have a number that's bigger than 2, we probably have lots of infrastructure. What our industry is means that we have a lot of building, so if you think about a power plant, right? You have to build the plant itself. If we think about a hotel, we have to build that building. That's a lot of infrastructure. That's a lot of fixed assets. So you're going to have a lot of fixed assets based on the type of industry that you are. Now, the other way we can look at the fixed assets to owner's equity is from the investor's perspective, those who are putting in the equity. If you have a fixed asset to owner's equity that's less than 1, then what that means is all that equipment or infrastructure is being financed by your stockholders. Okay. If you have a fixed assets to owner's equity that's more than 1, so the value of the fixed assets is more than the owner's equity, so the number is greater than 1, then we are financing with debt. Okay, so which would you rather have? Well, if the assets are being financed with debt, then the concern is, so finance with debt, which means the number is greater than 1, then as an investor, the concern I would have is that if the business goes under and we liquidate, we sell those first fixed assets, then the value of those, who gets paid first? Those who we borrowed money from. So the bigger the number, the more, if the company goes under, then we sell the fixed assets, that money goes to pay off the debts. And me, the investor, the stockholder, don't get very much. If the number is lower and something happens to the company, then when you sell off the fixed assets, me, the stakeholder, the stock, who owns the stocks, I will get a portion of that sales. So if we're looking at risk and the business going under, then a fixed asset to owner's equity that is less than 1 means that it's less of a risk for me, the investor. And if the number is bigger than 1, then me, the one who's buying the stocks, it's going to be a bigger risk to me because that means that more of those fixed assets are financed by debt and I'll be less likely to be paid out if something happens to the company. So let's go look at fixed assets to owner's equity. We have our fixed assets. Just Had a brain freeze for a moment. Wait a second, did I actually calculate that? Yeah, here we go. Our fixed assets to owner's equity. And we can see here that for the hotels, the number is greater than 1. So we're financing with debt. We saw a lot of that long-term liability. Okay. And we can see for motor vehicles, you can see that number is less than 1. Most of it's being financed by stockholders. So if you are an investor looking at the risk and you're concerned that these companies might go under and whether or not you're going to get a return, the one that's financed with debt, this hotel industry, is a bigger risk. And then when you add to that the fact that I am buying stocks and I am not getting anything out of it because the net profit is negative here, nobody wants to invest in hotels in 2021 in Canada. They're not doing so well. All right, so we've gone through these different financial ratios. We've looked at the hotel industry and the motor vehicle industry. And so I'm just going to return back to our slides here. So bear with me. I know this video is a little on the long side. So we looked at the hotel industry, their balance sheet, their income statement, and how to turn those into financial ratios to tell us about how the business is doing. The numbers that you saw and we've been comparing to come from this balance sheet and income statement from motor vehicles. So you're welcome to practice doing the calculations that you saw on the screen by working through this data as well. In terms of our class, we're going to have you do those financial ratio calculations for food service from this data here. That would be like restaurants. And so we can compare that to our pop-up to sell cupcakes at the farmer's market. So how do we compare in terms of performance? And we're also looking at Amazon and doing the same financial ratios for Amazon, comparing them to their industry, which is the non-store retailer data that you see here. So you should be able to calculate all of those same financial ratios that we have just done. Okay. We'll do one more video where we look at the interpretation of these ratios. So we went through what the number should be. Now, what if we're trying to answer questions about the company? Are the profits satisfactory? Are the assets productive? In a next short video, we'll go through which of these ratios will answer these questions for us. And then ultimately that will allow us to create some scorecards and some benchmarks to make some goals for our organization to improve its operations and financial management.